Pension fund works the same way, and they have reduced the benefits.
Yeah.
They have like 6 groups of employees now that are in the retirement system. The older ones don't pay anything. The new people pay a lot more into the system. So there's precedent.
In Illinois, the teacher population is having trouble attracting new young teachers, in part for this reason. And you're seeing more advertisements for retired teachers to come out of hiding and teach in the schools because of what the young people are facing on that score.
So Bill, I think we're ready to go.
All right, good. Welcome everybody to our Ask the Experts webinar. This is Truth in Accounting's Ask the Experts format. Thanks also to the Union League Club of Chicago for co-sponsoring. Today's topic relates to how bad accounting practices can lead to bad decisions, particularly in our governments, where we're concerned about the general welfare, stuff that matters for all of us. My name's Bill Bergman. I'm the Director of Research for Truth in Accounting. We're a nonprofit dedicated to helping citizens understand government finances with a view to promoting truthful financial reporting by our governments. You can learn more about us at our website, where you can also sign up for our morning call newsletter, which compiles government finance news every day. We also offer a Data Z website where you can create charts and research states, cities, and the federal government on a wide range of financial, economic, and demographic information. Today's event dovetails with current developments relating to a longer-term project of interest to us at Truth in Accounting. Our goal includes pursuing full accrual accounting for governments in the United States, state, local, and federal. Currently, the Governmental Accounting Standards Board, which is also known as GASB, they're accepting comments on 2 new proposal projects that they've put together. These projects, in our view, would continue essentially outdated and misleading cash-based accounting methods for governments and their budgeted funds. We'll get more into this throughout the webinar. We're honored today to have Kevin Bronner as one of our experts. Kevin's a professor at the University of Albany, a city in a very relevant jurisdiction for these topics in the state of New York, where he's also taught courses in microeconomics, governmental accounting, public finance, and more. Kevin was the principal utility financial analyst with the New York State Public Service Commission from 1970 to 2003. In other words, he's been around the block for a few years in this area, so we're really happy to have his insight on current events. He's been involved with auditing large electric and gas companies, including the audits of issues associated with Enron type problems in that area, a topic of interest for those of us in Illinois lately. He's a member of the American Society of Public Administration and the New York State Government Finance Officers Association. He's also authored articles in several recognized journals relating to government financial management. Joining Kevin and I today we have Truth in Accounting's founder and CEO, Sheila Weinberg. Sheila's a CPA, and she led the Truth in Accounting's formation and its initiatives ever since 2002. Her commentary on the federal budget, the Social Security, Medicare, and other national issues have appeared in numerous publications, including USA Today, the Wall Street Journal, and the Washington Post. For today's event, everybody's going to have a chance to ask a question. There's a Q&A feature down at the bottom of your Zoom menu. If you look towards the bottom of your screen, hover your mouse, you'll see a panel. Just type your question in that box at any point in time, and we'll try to answer it. I'm going to turn it over now to Sheila and Kevin for some comments, then we'll get into the questions. Sheila, what's going on with GASB lately?
Well, GASB, a lot of people may have heard of FASB, which is the Financial Accounting Standards Board. This sets generally accepted accounting principles for corporations, but the government's decided to create their own board for their standards, and that is called the Governmental Accounting Standards Board, GASB. And Truth in Accounting and others has worked for years to get GASB to require state and local governments to put their pension and retiree healthcare liabilities on the face of their balance sheet, so citizens would know what those true liabilities were. We won that battle, fortunately, but only at the consolidated level. On the consolidated state and local governments' consolidated balance sheet and income statements, those liabilities and related expenses appear. But unfortunately, governments don't budget on a consolidated basis. They budget at the fund level. And the largest fund, for example, is the general fund. And GASB does not require these statements to include these liabilities and expenses. They're done in essence on the checkbook basis. So you just record what goes into that fund and what comes out of it. So if you borrow loan proceeds, if you borrow money, that improves the balance sheet and the income statement at the general fund level. And if you choose not to properly fund your pensions, those numbers, expenses don't have to be included. So let me give you a couple examples of this, what this bad accounting does. In early 2019, Texas officials were touting a $13 billion surplus in its general fund. But keep in mind that did not include $75 billion of pension debt. Nevertheless, based upon that surplus, within weeks, the state legislature passed a final budget that included salary increases and property tax relief, which is led to a further deterioration of the state's overall financial statement. So again, these general fund statements said we have a surplus, but they didn't include all the numbers that are needed, like the $75 billion of pension debt. The worst or best example, I'm not sure how you say this, but the worst example is CPS. There was a headline we found in the Chicago Sun-Times in early 2019 that said CPS finished the budget year with a surplus just right before contract negotiations. So the article noted that they had more than a $300 million surplus, but this money was left over because they didn't properly fund their pension plan. In fact, the pensions, even though they said they had a surplus of funds, the CPS owed $12.3 billion to its pension liability plans and $2.3 billion to their retiree healthcare plans. Regardless of that, the teachers union said, hey, obviously the school district is telling us they have extra resources and those resources should go in the classroom. And over the next few months, they negotiated a contract that included salary increases and a nurse in every single school, despite the fact that for years, they have not had enough money to pay the proper amount into their pension plan. So we're trying to get this accounting change. We really believe that citizens and elected officials need the information to decide, are we running a surplus? Did we balance the budget or not in the general fund? And fortunately, we're in a very unique window where people can comment to GASB and say, hey, stop this insanity. We have on our website, truthinaccounting.org/letter, a form letter that you can fill out and also modify if you want to send to GASB, so you can be part of this process of getting these accounting standards changed. So the general fund has to be properly accounted for. And as you mentioned, Bill, we are honored to have Kevin here today, who will discuss more specifics in his state and his concern about what this accounting does for pension and retiree healthcare liabilities. Kevin.
Okay, well, Cheryl and Bill, thanks for having me here today. I just want to make a few points before we get into the weeds in this. I started working on this OPEB issue back in the 1990s when I was with the New York State Public Service Commission. And the Financial Accounting Standards Board had a statement, I believe it's FAS 112, that said you have to have OPEBs for private companies. So we had to implement that whole system into the regulatory process.
And Kevin, by OPEB, you mean
other post-employment benefits.
Oh, okay. So like the retiree healthcare benefits.
Yeah, the retiree healthcare benefits. So,
okay, thank you.
Back in like 1993, we had to implement this in the rates for utilities in New York State, and I was on the team that did that. So that's where I first got involved with this, and it was for private companies. And the other day, I looked at Con Edison, as the big electric company in New York City. They have $1.2 billion of this on their balance sheet. So they have to use accrual accounting, the private firms. Now, the specifics of this for government, I first got involved in this in 2006 with the old GASB 43. That was the OPEB, the initial statement they had on that. And I've been commenting on this for several years in various GASB proceedings, one of which is GASB, the statement number 75 has to do with OPEBs and pensions. And I did send in my comments this year early in January, and they were basically in 3 areas. And I'm just going to discuss the OPEB area for now. If there's more questions on the rest of my comments, I can certainly take them. So my comments start off, I really think you should have a long-term focus for the OPEB liability. And it should be used in all governmental accounting financial statements. And I really think full accrual accounting should be used. Now I have off to the side here, I just have an accounting textbook that we use at the university. And one of the bases of accounting is the economic resources measurement focus. That's what businesses use. So that means full accrual accounting. And when you set up some kind of a transaction, it becomes an exchange transaction. And that's when it should be recognized. Now with this other post-employment benefit liability, there's an agreement with the employees to pay the money. So that's why I think you should use accrual accounting. And I think it should be placed on all the financial statements. Now, as far as the specifics of the GASB statement that they put out on June 30th last year, I get into the real specifics of this. This is what I call the weed type of stuff. So if you look at page 78 of their presentation, they start talking about some financial statements. And this shows, I'll just keep the numbers round. In the illustration, there's like a $298 million OPEB and pension liability shown on the government-wide financial statements. And then if you get a little bit further in the financial statement, these are the GASB illustrated financial statements now. You can't really find where that liability got split up, where it went to, because they changed the basis of accounting and they used the short-term focus. And what they make you do, you have to go through a series of reconciliation statements to try to figure out what happened. So I don't like that method at all, to have to do that. I remember in October 2013, I presented a paper at an American Society of Public Administration public finance conference, and I went through all these reconciliations that large cities had to do, and I just showed it was a cumbersome exercise for people to understand. I'm talking about finance professionals now. So to me, this is really a transparency issue. I really think you need, if you can show me that there's a $298 million liability on the government-wide financial statements, you can also show me which portion of that goes to each fund, and it can be on the financial statement. And the model as they presented it talks about reconciliation statements with different bases of accounting in them, and the terminology even lacks transparency. I've discussed sometimes in New York State, we have a very well-funded pension system, and we have another post-employment benefit system that isn't funded. So when you take the two of them together and put them on a line, one single line item, the way the GASB did in that exposure draft, it's improper because you don't get the full picture. So I'm even questioning them on some of their terminology that they're using on these financial statements. I think there should be a separate line for the other post-employment benefits and a separate line for the pension. But just to continue on with this, I run a daily project here where I study bond ratings for most of the local governments in New York State. Not all of them, but most of them. There's like 1,600 local governments. And about 700 of them are school districts. I don't do as much work on those. I do some, but all the other local governments, I follow them every single day. And I use Moody's Investor Service to do this. And they clearly say a high level of OPEBs, other post-employment benefits, can have a negative influence on bond ratings for local governments. So I really think you need transparency in presenting this OPEB liability. And that's what, of the three comments I've made, that's what they're really, that's the OPEB piece. And just, there's an old, I'll hold this up just for a minute. There's an old, I don't know if people can see this, but there's an old, it's not that old, GASB 75, which is for OPEBs. And the first sentence in that, I just want to read it to you and ask yourself, do you really think that this new model they're developing complies with this first sentence of statement number 75? And it reads, the principal objective of this statement is to improve the usefulness of information for decisions made by the various users of general purpose external financial reports. In parentheses, financial reports of governments whose employees, both active and inactive, are provided with post-employment benefits other than pensions. So in that statement number 75, they talk about the financial reports and the users. And I just think the users would have a very difficult time in this new model they've developed for the reasons I put in my comments and that I just discussed.
Oh, thank you. I know Bill has questions. I just want to comment on some of things and ask for some clarifications. I totally agree with you about the users. I think one thing GASB forgets is they think of users as government finance people or bondholders. I think that they forget that probably the most important users are the taxpayers, the residents of those jurisdictions, and the elected officials. And we need to get information to them in an understandable format, which I don't think this does. And then you mentioned the exchange transaction, and I just want to clarify that. This you're talking about how an employee, when they work, they earn compensation. They have a compensation package, and a part of that package is salaries, which does get included in the general fund statements because those are checks that they write. But then they also earn the right, the exchange transaction is they earn the right to receive pension and retiree healthcare benefits. And those transactions are not completely being recorded because governments are choosing to defer funding these or paying these benefits. Is that what you're meaning by exchange transaction?
Yes, yep, exactly. Yep.
Okay. And then I guess the counter that I hear from GASB members and others is that, well, if you want this long-term perspective, you can just look at the government-wide financial statement. So the governmental funds are done on the short-term basis, but if you want a more complete picture, look, why can't people just look at the government-wide statement? What would your answer to that?
The best answer is the Moody's investors aren't going to buy a government-wide financial statement bond. They're going to buy a general obligation, and that means the general fund should show the liability. If they buy a water company bond that's a proprietary fund, they can financial statement, go to buy that bond and get the answer. But you can't get the answer in the governmental funds. If you buy a general obligation bond, which is really a general fund bond, you don't get the answer unless you go through this reconciliation process. That's why I think it should be put on the balance sheet. And if I could just add, this just isn't, I'm going to hold up the old GASB 34 here. I haven't been a big fan of that for a long time. That was from 1999, because you don't show the debt and you don't show the assets on the balance sheet. That's another problem that is involved here. I'm focused in on the OPEB piece, the other post-employment benefits piece. And that's part of the GASB 30. Part of the problem comes from the old GASB 34.
Definitely.
There's some real, I'm not going to get into the detail here, but I just drew up the journal entries that you can use under GASB 34. If I wanted to increase my fund balance, all I have to do is near the end of the year, issue some debt and I get cash coming, and then my fund balance goes up. Then after
Is
the
that
first,
true? Is that true under the current proposal? True as
I
well,
believe
Kevin?
so.
That's my impression too.
Yeah, yeah.
It just continues that possibility.
That's just an old GASB 34 piece, because if you, the way this would work, if you were going to issue $1 million in debt for a building, and I'm going to get into the accounting stuff here. I hope I'm not too much in the weeds. You're going to debit your cash for $1 million, and you're going to credit an account something like other financial resources debt. And then at the end of the year, you've credited this account, other financial resources debt. So at the end of the year, you have to debit that account and you credit fund balance, so fund balance goes up. And there's a similar accounting entries when you spend the money on the building. It works the same way, except it reduces fund balance. So what I'm saying is, if I wanted to increase my fund balance by building $1 million building and issuing debt to do it, what I would do, I could spend the money in December. My fund balance would go up. It'd look better because I went more in debt. That's kind of counterintuitive. And then in January of the next year, if I spent the money on the building, my fund balance would go down to where it should be. So I've never liked this, most of this GASB 34 process here.
Yeah, and we have a great example, or again, it's a good example or a bad example in Illinois, where when the Illinois comptroller issued the 2019 financial report, her headline was that the general fund deficit decreased by $6.8 billion. But if you look at, if as a CPA and knowing the financial statements, I was able to track down that, they borrowed $6 billion. And that is included in the fund balance. The offsetting liability isn't included, but they reduced, the deficit in the general fund by $6.8 billion by borrowing money.
Well, Kevin, I got to ask you, to dig into this a little bit further. The first thing that caught my eye, by the way, you can see Kevin's, for the audience out there, Kevin's comment letter is at GASB. I encourage you to take a look. It's nice and succinct and clear. And it talks about, in his second element of his discussion is the difference between, quote, short-term measurement focus versus long-term measurement focus. That's what caught my eye and made me reach out to you, Kevin. Why is this short-term focus perhaps inappropriate, and or why? These are fund statements, right? Why shouldn't they just include short-term debt when payments are due? Why should they include longer-term obligations, in your view, in the fund statements?
Well, I think you should include your assets, your buildings, your roads, your infrastructure as assets, and I think you should have the debt on there as well. So to say that I'm just going to look at it, the reason I use the short-term focus is that, remember, there's an old budgetary basis of accounting argument here that says, well, we're going to budget year by year, so we only have to put in, the focus has to be on the year-by-year budgeting. That argument, I don't buy that argument. I mean, utilities and private companies also have budgets year by year, and they put in all their assets and liabilities on a long-term basis. So I just don't see the consistency. As an accounting person, I just don't see the consistency in this at all.
Well, and it's interesting you mentioned the proprietary funds.
Right.
So the government-wide funds are done correctly, on this economic resources full accrual. The proprietary funds are done, but for some reason, as you mentioned, because of this budgeting, the general fund and the budgeted funds are done on this short-term basis. And, they're sort of like, and some people argue that, you need to keep that, as you're saying, that you need, because it needs to tie to the budget and how they calculate the budget. And I would say, well, they calculate the budget on a cash basis, which is so misleading and incomplete that the IRS doesn't allow a corporation that makes more than $26 million to do, their books this way, but that's how they budget. And then why would you want to take that bad accounting and then budgeting and use the same standards to do accounting? They would agree with each other, but both of them do not show a complete picture.
Well, Kevin, you call for a single accrual basis for both governmental and business activity funds. That's a direction that we support and encourage, and hopefully we'll be moving in that direction in the future. But along these lines, in the new proposals that you commented on, GASB is calling the proposed measurement focus the quote, short-term financial resources measurement focus and accrual basis of accounting. In other words, GASB is claiming that this is accrual basis accounting. Is, in your view, is this what they're proposing? Are they trying to make the accrual shoe fit on the wrong foot? Is this really accrual accounting?
Accrual accounting for 1 year only, whereas this transaction they're trying to account for, let's say a pension or other, let's stick with the other post-employment benefits that I commented on. Somebody retires at 60 years old for a government, they'll probably live till their 80s most. So it's a long-term transaction and you're accounting for it on a short-term year-by-year basis. And I just don't see how it's consistent at all. And another problem with this, you can take like the town I live in has about $100 million budget. So they have a government-wide financial statement that shows the OPEB liability. They have a general fund financial statement that doesn't really show it. Then they have water funds, a water fund that shows the liability. That's a proprietary fund. That water fund budgets year by year, just like the general fund. So when someone says to me, you have to use this financial resources measurement focus with a 1 year focus, none of this is ever consistent. The same people who pass the budget for the general fund pass the budget for the proprietary water fund under New York state law. So why you can just say, well, the water fund has to show the liability and the general fund doesn't have to because they use a 1 year budget. There's just no consistency in this at all.
And I
The
think
argument just falls flat on its face.
I think it confuses, the elected officials also, because again, they're not government financial people. But I know I once was listening to a school board's hearings on the budget, and one of the people said, well, I don't understand why, these pensions and why these aren't included in the general fund. And the answer was, well, government accounting is different than corporate accounting. And it's like, and as our former US Senator used to say, he never understood why 1 + 1 in the government is a different answer than 1 + 1 outside the government. And we had Ian Ball from New Zealand, who they implemented full accrual budgeting and accounting, and the budget and the government accounting now is a lot closer to what the corporate accounting is. In fact, I think it was Australia or New Zealand, they said they no longer have government accountants and private sector accountants because accounting is accounting there. And you don't, it dumbfounds me that in universities and to pass the CPA exam, you have to learn this other whole different type of accounting that's used in the general fund and other governmental funds, different than any other accounting that you're learning for corporate or anywhere else.
Along the lines of elected officials, one story we can share is the city of Chicago claims to balance its budget according to state law every year, and yet the city of Chicago has accumulated massive both OPEB and pension obligations in that, despite the fact that it balances its budget. I once asked a member of the Chicago City Council, a member of the Finance Committee, how can you claim to balance the budget every year when the debt goes up and up over the long haul? And his answer was very succinct. He was almost proud. We borrow the money to make up the difference and effectively, and that's how we balance the budget. It's almost like planning to run up the credit card and tell your spouse that that's how you're balancing your budget. And that's the consequence of this. Okay, we've got some good questions here. I've got a really simple one from someone who wants to know. I think it's a good thing to start with a good simple one. Michael Horsley's, you talked about consolidated financial statements. What are they consolidating? What's going on there?
You might have 4 funds, 4 accounting funds I'm trying to keep this very simple, in a local government. So what you basically do a consolidated statement would add the numbers together for all four funds and say, this is the government-wide financial statement. So it's a simple, to start this discussion off, it's a simple addition of all the numbers. So you'd have four funds, and then you'd have a fifth column that would add everything up. Now, the problem we have with this model that GASB's using is that the funds use a different basis of accounting. So the general fund uses like a financial resources measurement focus with modified accrual accounting. The water fund uses accrual accounting. So the numbers are computed differently in the financial statements. And what you do, then you have to go through an exercise where you convert all, like the general fund, you have to convert all the numbers into an accrual basis to put them into that consolidated statement. Now I'm getting really into the weeds here, but that's the way it works.
Sometimes simple questions are the best ones.
Yeah, oh yeah. So it basically it's an addition. If there's four funds in a local government, you just add them all together. That's the simplest way to look at it. That's a consolidated statement.
Yeah, and you can think of it in relation to a corporation where you have subsidiaries and the parent corporation. Well, in that case, you add up all the subsidiary numbers plus the parent corporation, and you get to the consolidated numbers. But you can't do that in government accounting because they don't use the same accounting basis. So you have to do the governmental funds, you have to do a reconciliation in order to, recast the numbers so they agree with all the method that everybody, the proprietary fund and the overall fund is using. So it's just a consolidation of all the numbers, but it's more difficult because of the two different accounting bases in governments.
Right.
Here's a little more sensitive question, and it's appropriate, I think, for Kevin, given his experience both in utilities and government. The question from Richard Skiba is the following. If a business or utility presented financial information one way and called it truth, then presented financial information with less information and called that truth, what would that be called? A leading question, perhaps. But
well, we could look at that for businesses. You mentioned the Enron scandal from years ago. I had to work on that because I was the principal financial analyst for the New York State Public Service Commission. And we could see the numbers didn't add up for Enron. And what they would do, they had these off-balance sheet financings where they took a lot of money and they put it at risk. One of them was called like a Raptor entity. So they set up all these special purpose entities that were kind of used in the fishy accounting, and then you'd add them to might have been the normal accounting. They had some normal accounting. But there were two systems of accounting going, and when they tried to hide the real losses in the consolidated financial statements, but in the end, all those special purpose entities failed, and the company went bankrupt. It's kind of an extreme example. I'm not saying that governments do that now, but it's possible. You can hide the real picture here if you want to.
In theory, I'm afraid very simple things like counting borrowing proceeds as revenue and hiding debt off of your relevant balance sheet, those are Enron type problems that effectively, I'm afraid that GASB is trying to cement with their current proposals. And that's why it's worthy of pursuing what Kevin did. We're really happy you provided your letter for GASB and hopeful that other people can do the same thing. Okay, another question. Let's just thinking about a specific financing technique that's out there and increasingly popular, but with some issues associated with it. We have a question about pension obligation bonds from Thomas Hartwell. Perhaps, Kevin, if you'd like to discuss what pension obligation bonds are. But the question is, my town is considering doing pension obligation bonds to deal with its unfunded pension liabilities. What is your view on this? And perhaps you could talk about the accounting and in turn the proposals for GASB, perhaps there's a lot of meat under this question.
Well, let's say over the next 10 years, you had a small town and it looked like it was going to be $1 million short in its pension funding over that period. And then after that period, the pension would be fully funded for some reason. Maybe the tax base grew. So the argument is, well, during the deficit period, instead of raising taxes, we can issue a pension bond and fund it that way. Now, I've done a lot of finance work. I'm not really against pension bonds. I'd have to see how it's structured and what period it covers and all that. But it is an option to finance a pension if need be.
Yeah, it reminds me when I was on a panel with former Governor Boboyevich's budget director, and he was touting that they had put more money into the pension plans than any other administration. And I was like, well, how are you calculating that? And they're like, no, we've put more money in. And then I was like, yeah, but you borrowed $10 billion.
Yes.
And then you only put 7 of that into the pension plan, but 7 billion of it, the rest of it they use for other current contributions. So yeah, the thing one issue I have with pension obligation bonds is it kind of takes the pressure off of doing any reforms to the pensions, because it's like, oh well, we don't have to worry about that for another 10 years, and so it takes that pressure off where and again, should future taxpayers having to pay that bond off when those employees don't work for those future taxpayers.
Yeah, there's an intergenerational question with any kind of a bond issue. I agree with that. You have to look at it carefully. What often came to mind when I'd hear about pension bonds, I just would think about the demographics in our whole entire country. Now, right now, there's an elderly population. Let's say in 2070, maybe the population will be a lot younger. Well, if that were to happen, you might be able to issue some pension bonds maybe in 2060, because the population is going to get younger and people could finance the bonds pretty easily, the younger generation. So it has to do somewhat with demographics. I've never really analyzed all the statements that go in, all the studies that go into a pension bond. I got a good idea of what they are. That's why I say you have to make a careful analysis of it. If you're just going to issue a pension bond just so you don't have to raise taxes and you can say your pension fund's funded now, that isn't really true, because now you have more debt. So you'd have to look at it carefully. But I'm not going to totally rule it out. I think it could be structured properly.
Yeah, it's a complex issue. At the end of the day, though, there are the distributional consequences. The pension fund, at first blush, is unambiguously better off, but the general public is paying for that better offness, and that maybe the general public needs more of a say in these types of issues. Here's a longer question with a more specific, some interesting stuff in it. Michael Hubert, I'm a financial advisor in Southern California. I'm not a CPA, nor do I think accounting is my specialty. My question is, with all your talk about today and the conversations on truth in accounting, I'm curious, what do you think happens? What's the end result? And what this fellow is raising is broader macroeconomic consequences. Where are we today in our state and local governments as a consequence of the accounting in the past? And what economic consequences do they have? In turn, he raises questions at the federal level, whether or not the types of issues that you're discussing today, Kevin and Sheila, do they matter at the federal level as well? So anybody who wants to take that one on. Go ahead.
What comes to mind, California's in pretty good shape financially, the state itself. You hear a lot of criticism of it, but it's generating a lot of tax money. So it's hard to say, unless I tore into it and did a study. I'm trying to answer because this is from Southern California. I'd have to do some more work. My comments really had nothing to do with California. Now, if you look at New York State, you can say, well, New York State's, you can make a broad statement. New York State's in a mess because of pensions and other post-employment benefits. You could say that. And if you looked into the numbers, like I said, I've tried to say before, the pension fund is funded because New York state law requires them to fund it. The pensions aren't funded. So the policies themselves can work. It seems to work in the New York State pension fund, but it doesn't seem to work in, the lack of a New York State OPEB fund. And as I've been saying for probably 5 or 6 years, the state controller in New York has been asking to have the OPEBs funded. So it's not always the policies themselves; it's the people who are determining how the policy should be put into effect.
Yeah, and I think this has, direct relationship to the accounting and the way governments budget, again, on this cash basis. Because in California, before the current crisis, they were touting that the state had a surplus. And,
Yes.
so, billions of dollars. But, our financial state of California, shows that they had unfunded pension liability of $107 billion. They had unfunded retiree healthcare liability of $114 billion. Overall, we have that they needed, $264 billion, the highest in any state, to fund their unfunded debt, which works out to be about $20,300 per taxpayers. So they're generating a lot of cash. And but they're not pre-funding their pension, their OPEB liability. They do have some money set aside for their pension liability. But again, this accounting, because at the general fund level and the budgeted funds, it's showing that they show surpluses, but those don't include the assets related or debt associated with that. And once that debt is, I don't know, should governments say they run or have a surplus or ran a surplus if they, owe a lot of money? Would I tout that I have a surplus if I, had a balance in my checkbook and ignored my credit card debt? Should I go around saying that I have a surplus?
I think it should be. Yeah, I think you should be consistent in it.
Okay, here's another consequences type of question, more from the investor community side. Tom Carlton asks, suppose that governments convert to accrual accounting for their general funds, covering both OPEBs and pensions. What might the effect be on the investor community, like hedge funds, pension funds, and private equity money investing in municipal bonds? Again, we're accountants. We're not necessarily predictors of financial outcomes, but what impact would this have on the financial process?
Well, I think you would have to also accrue the effects of the property that the government owns. So there would be, in addition to the balance sheet, for all the assets, the long-term assets that they own. So there may be a very minimal effect. We'd have to study it for a particular government. But to just go on and say you should ignore, I don't even think you should. I think you should use accrual for the whole general fund, not just the OPEB and pension piece.
Yeah, and then there is some argument about that, the assets cannot, the capital assets, unlike Chicago does, you shouldn't be selling your assets to cover those debt. But they do, in the proprietary funds, they do come down to a number called unrestricted net position, which is where they, again, back out the assets again. So you could see, in essence, what we calculate as our money needed to pay bills. And, I think the question is I think that I hope, or I would assume that this is where the bond analysts and other government financial people have an advantage over just the public. They have the expertise and the wherewithal to understand, that these general fund statements are not being, everything's not being included. So I believe that the markets, the bond markets are already taking these liabilities into account. But again, the public, when they're told, oh, the budget's balanced, we're running a surplus, they assume everything is fine. And then all of a sudden they're like, well, yeah, but we do have a structural deficit. We do have a surplus, but we have a structural deficit. And they're just messaging the people. And I think it has a current negative effect on the public and the voters, because they're voting based upon these false statements that we have a surplus, and we have reserves, and people are making decisions on tax and spending policies, or who to even vote for based upon those comments. And unfortunately, the way the financial statements for the general fund are prepared, they support those comments that we have reserves and we have been balancing our budget.
See, with this accrual, there's one way it could really help them. The local governments, when I read, like I said, I read Moody's bond action reports every day for local governments in New York State. And often the Moody's analysts, they can figure out what the OPEBs are and the pension and the debt, even though it's not on the general fund balance sheet. And they'll say, well, the OPEBs are improving, so we're going to increase the bond rating. Or the OPEBs and the debt are getting a lot larger, so we're going to decrease the bond rating. Now, there's no commentary on, are there any good assets behind any of this? So if you had that piece of it, and this is going a little bit beyond my comments, but if you had the full accrual accounting showing good infrastructure and assets, that may actually help their bond. Doesn't necessarily mean accrual accounting will reduce the bond rate.
And yet,
I hardly ever see a Moody's analyst in these action reports say, gee, this town has great infrastructure, good assets that are worth a lot. You never see that because it's not on the balance sheet. And if it were, in a lot of cases, I think it would help the governments.
If it were on the balance sheet, Kevin, my question for you is, should they also be booking a liability for deferred maintenance obligations?
Yeah, and depreciation would be another thing, cost you'd have on there, of course.
Yeah, those deferred maintenance obligations may be very large. And again, that's another topic for consideration.
Yes.
Well, speaking of bond ratings in the bond community, here's a question from Barrett Peterson. Does Moody's adequately consider pension and OPEB liabilities in their ratings? I don't think so. This is what Barrett Peterson is saying.
Well, like I said, I follow the local governments in New York State. Almost every day there's a change in one of the ratings, or the rating will be affirmed. Most of the time they're affirmed. But they do comment, like I said, they do comment quite a bit. They'll say the long-term liabilities such as debt and other post-employment benefits and pensions are reasonable. So we're going to hold the bond rating. Sometimes when they lower the bond rating, they say they aren't reasonable. Well, I don't have any access to their analytical work that they do to come to that statement. They're claiming, they do consider it.
Yeah,
they have bond rating methodologies too, where they have scorecards. They figure out a score. It's kind of unbelievable when you think of this. Somebody like Moody's has a financial scorecard for every local government in the United States that has bonds. And a couple of years ago, I said to them, how do you do this? I said, to have a scorecard for like New York City or Chicago, and you want to compare it to Dubuque, Iowa, you have to have all three of those databases set. And they do. They claim they do because they have a scorecard for all of these people. And some of the negative items that can affect your bond rating in the scorecard are pension and other post-employment liabilities. Now, a couple of weeks ago, Moody's just issued a big paper about school districts, and they're going to review like 700 school districts across the country with this new scorecard. And pensions and OPEBs is a big part of that scorecard.
Well, Sheila,
yeah, we found when we did a webinar on the bond ratings that what we were told was it does OPEB and pensions do affect the bond ratings, but it's a very small percentage. It's probably, they have like an other category that's probably 10% and included in that other category. Because we find that, for example, Delaware, we have them in our rating as an F, and they, Moody's gives them a very high rating, and I think a AAA. And I think that the bond ratings measure something different than the financial statements and then our ratings. And what people don't understand is the bond ratings do not measure the overall financial condition of a government. The bond ratings is a measurement of the risk involved in those bonds getting paid. Are the bondholders going to be able to be made whole based on the assets the government currently has, or the future tax revenues that's coming in. And if that's true, then they get a high rating. Our rating is more of almost like a taxpayer risk. Here is the risk that you're going to be forced to pay future taxes or have less services based upon the government's overall financial condition.
Yeah, you're right. The weighting factor, I don't have it in front of me, but it's about 10 to 15% Moody's uses in their scorecard system for OPEBs and pensions.
Well, Sheila, you answered my question, even though I didn't ask it. That was, it was a good way to think about this. Here's a question from an anonymous attendee that oftentimes anonymous questions are some of the best. Here's the question. Is there any practical reasoning for why different government funds are allowed to use different accounting methods? Is it all just a scheme to make it easier to get around balanced budget requirements? Or is there a practical and useful purpose for having different methods for different funds?
Okay, to answer that, I get back into my local town and their budget. There's, again, I'm simplifying it. There's about 4 funds. There's a general fund. There's a water fund. There's the sewer fund. There's a landfill fund. The last 3 funds are proprietary funds that use accrual accounting. The first one is a general fund that uses modified accrual accounting. The budgets for all 4 of those funds are passed every November by the same town board. So there's no difference in the budgeting for any of this. So I just go back to what I keep thinking about. I don't see any reason to have a different accounting system for any 4 of those funds. Whether or not it's a scheme or not, I don't know. I just like internal consistency when I look at an accounting system or I look at a bond purchase. You want to make sure everything is consistent. And this model, again, I go way back to the 1999 GASB 34 days. I was never a big fan of that whole model.
Yeah, and I think consistency is one of the negatives of this model and the proposed model, because, for example, if a government chooses to fund its OPEB, retiree healthcare benefits, that is a reduction of their general fund balance, and they would look worse looking at on a general fund balance level than a government who chooses not to fund their pension liability. So there's no consistency in how how these fund balances are looked at.
But where there's other players that are important in this. Let's look at the bond rating firms again. Let's say you're a pretty good Moody's bond rating, an AAA level, and all of a sudden they change their OPEB and pension weighting factor from 10% to 40%. Well, then you may lose your bond rating. So there would be an incentive to fund these things and manage it properly. And a bond rating firm, to me, is one of the best entities we would have to help correct this.
Okay, here's a question from Thomas Hartwell again, a good one. Is there any public unit in the US that's actually showing and explaining a reconciliation between their cash basis budget versus an accrual basis? Here's what he said. I'm trying to get my town to disclose this.
Well, under the GASB rules, there is a reconciliation statement that they would put out. So if you look in that general fund financial statements, go to the balance sheet. I don't even know what town this is, but in most governments, you'll have a sheet behind. It's called a reconciliation statement. It'll be right behind the balance sheet in the order that the pages are put together, and it'll have the reconciliation. It'll show why items like pensions and OPEBs are in the government-wide financial statement and why they're not in the they'll kind of give you the amount that's in the general fund, but you know, you don't have any numbers to explain it. It may say like, you know, there's $6 million of unfunded pension and OPEB liabilities. So there is a reconciliation statement that you can get into, and with a little expertise, you can get some idea what the pensions are in the general fund. This is the paper I did in 2013 before the American Society of Public Administration, where I went through all the, I got really into the weeds of all these big cities. Chicago was one of them. I did it for them, Philadelphia, New York. So you can do it, but I'd rather do away with the reconciliation statement. This was part of my comments because they even changed terminology in the reconciliation statement. So it's very difficult to follow.
Yeah, it's interesting as far as terminology. They talk about the income statement for the general fund, which is actually called the statement of revenue and expenditures, and changes in fund balance. Notice they're using the term expenditures. They don't use the term expenses. So this reconciliation goes, okay, expenditure means the checks that you write. What expenses did the general fund incur, and other governmental funds during that period, but they're not dividing it up between the funds. It's all whatever the governmental funds, they're doing the reconciliation. And as Ian Ball said, when we talked to him, their governments budget on a full accrual basis, and they do the financial statements on a full accrual basis. So there is no reconciliation needed because they're doing everything on the same basis. And I think the question was based on the budget, and there's no reconciliation in the budget. We can't make, as CPAs and financial experts at Truth in Accounting, we usually cannot ascertain what the budgets are doing, and it's very difficult to figure out what the true expenses are in these large budget documents. So we rely on the financial statements, but again, those aren't current budget numbers. Those are historical numbers, unfortunately.
And then just to show you, it's kind of off the wall, but in the general fund, if you spend $100 on a salary, it's called an expenditure. If you have a water fund that's a proprietary fund, you spend $100 on a salary, it's called an expense. This is the type of complication we need.
And then on the water fund, because it's done using full accrual, it would have the $100 plus the pension and retiree healthcare expenses included. So if somebody is working on the financial statements, as far as consistency, if you're looking at employee expenses on the general fund, those would actually be less than they would be on the proprietary fund if you had the same number of people making the same amount of money. The general fund expenses would be less.
Here's one final question we have time for. It relates to what some people argue is a arbitrary distinction between the short-term and long-term measurement focus. And the question is the following from Barrett Peterson, quote, keep in mind that pension and OPEB liabilities are present values, not the full amount that's ultimately payable. These is this a current or a short-term, wouldn't a short-term measurement focus incorporate understanding what that current present value is?
Well, if you have a 20-year pension fund in it, you present, the reason the idea behind present valuing it back to 2021 is that you do have a fund that you invest money in and it can earn money. So let's say it was a $10 million payment over the next 20 years, you don't need $10 million now because portfolio you have behind the pension system will earn some money. Like in New York State, I believe the pension for the state and local government retirees, about 85% of it comes from the earnings on the pension. So that's why you would discount it. Now, if you don't have a fund, like an OPEB fund, they discount that back too. So there's a whole difference in the way you should be looking at it. Because you don't have any money to invest, so why discount it at all?
Well, in Illinois, Kevin, we have a law that apparently the Supreme Court has deemed that these obligations are ironclad obligations. Should they be discounted at the investment rate of return, or should they be discounted at the risk-free rate of interest?
Well, if they have a fund, if they have an amount of money they can invest, you try to discount it at what you think the portfolio is going to earn. And of course, there's a big trick in this. Let's say it earns 6% and you want to limit the liability. So you'll say, well, we're going to discount it at 10% to minimize it. So there's all sorts of things, games they play with this. But it should be the discount rate for the government, what you think you're going to earn in the fund, or perhaps maybe a municipal bond rate. You'd use that as a rate if you wanted to.
Yeah, but before we wrap up, I just want to encourage everybody who's listening to consider writing an email to GASB, asking them to stop going down the current road, to reject the current exposure drafts, and let's try to rethink this and get rid of this bad accounting that allows them to show reserves, allows them to claim balanced budgets when they really haven't balanced their budget. You can go to ourtruthinaccounting/letter, and there is a email that you can send to GASB asking them to do this, or encourage you to contact us. We're happy to help you write a customized letter. So feel free to contact us. Bill, anything else?
That's all we got time for today. Thanks for all your questions, and thanks for your interest, everybody. If you had any more questions, please reach out to us, and I encourage check out Kevin's letter, a good, short, and succinct, but well-argued letter. So thanks all again for being with us today, and we'll see you again.
Thanks, Kevin.
Okay, thanks, Sheila. Thanks, Bill. I'm going to leave the meeting then. Okay.
All right, bye-bye.
Bye.